won't be here. Okay, and let me see what else do I need to make here. Make this one a worst. Okay, so good afternoon, day people. Let's meeting here for the purposes of this class, our FAC3764, a new module. Yes, the module code is new, but the content of the module is what you are used to. The content of the module is still the same old stuff that was done many years ago. Okay, so in this module, people, we are going to be looking at financial accounting, right? And if I'm not mistaken, I think they said there's no exam for it and stuff like that. It's just a series of assignments. But you would not say that because it's assignments, I'm not going to attend, right? I'll just find someone to assist me on the assignments. No, you can't do that, because at some point in time, it is going to catch up with you, especially for those that would want to start further, maybe to CTA level, to honors level. You will have serious problems there, because you arrive at that level, a high level, you arrive blank. So advise us to please find a place where you are going to attend. As long as the guys are good, it's okay. I'm not saying come here. No, there are many of these tutorial service providers. You are fine with them, just go there. If you want to come here, that's good. We'll push together. Okay, so what I'm saying is we should have the foundation of this knowledge. You need it. Even for a workplace, if you're not going to study further, they should see that you are someone who did a degree in accounting and not a questionable person. Otherwise, you bring a degree into question. When they ask you a simple thing, simple accounting treatment, then you say strange things as an expert of the company. Okay, so this part is going to be a year module, so there's a whole lot of quantity to absorb. We need to keep up with the workload that is set before us there and absorb basically everything for us to be in a position to what? To say that we did the syllabus, we covered the syllabus. Right, the module is broad. I'm going to be taking you through this module together with my other friends throughout the whole year. We'll be interchanging this topic, he does it, the other one I do it, and stuff like that. It's going to be quality. You don't have to panic. All of us are people we have studied our accounting up to the IST 11, right? So relax and sit back and enjoy and be guaranteed, not guaranteed per se, because you also need to put effort on your side and pass. Okay, so since this is gonna be a 2-hour thing there, and since this is just a free class for you guys, in case others maybe want to benefit as much as possible, and actually day one, maybe you won't be continuing with us, or you won't be starting with any institution that provides what classes, I will make it worth your time. So what I mean by that is I'm going to tackle a difficult topic for students as far as accounting is concerned. Okay, so I've chosen that one so that you benefit to the highest degree. So the topic that I'm going to cover with you today, good people, I am going to look at income taxes, right? I'll look at income taxes with you. That's an accounting standard. That's our IAS 12. Right, when you are studying accounting there, you are basically studying the accounting standards, isn't it? Those IFRS book, maybe you've seen them somewhere or being dragged around by the auditors. Right, so they are selected IFRS that you must go through before you are eventually deemed fit to pass this module. So between now and the time that you are going to complete this module, Between now and the time that you write all your assignments, we'll be covering those IFRS standard, one after the other, all the way until we're done. Right. So I would suggest that you guys attend all classes. This is investment. Knowledge, education is investment. Right. You reap the rewards in the future. Right. When you go next year to start your CTA and other qualifications there, if you're armed with the right information, you would be good to go. Good to go. Okay. Let me just mute there. All right. Without wasting time, because we've got limited time, let's start with the. Let's start. I'm going to do IAS 12, right? That's your income taxes, right? There are other standards. So IAS 37, they are there. IAS 8, they are there, but we can't do all the standards on day one. So I picked this one, which is a challenge. Other people can actually even tell you that I can teach you everything, but I can't teach you income taxes. It's tricky, it's complex for me. It is the one where you find some funny things such as deferred tax. All right, let's move. Income taxes. This is our IAS 12. Right. When we look at income taxes, good people, we are looking at determination of the tax liability that the company will have to pay over to SARS. The tax liability payable over to SARS is determined according to what? To the tax rules. The tax rules are contained not in the IFRS, but in the Income Tax Act. So basically, for the purpose of this topic, we are looking at our income tax. So we are actually assisting the tax modules, right? Because we are supposed to learn about the taxation of a natural person, the taxation of a company, whatever, whatnot, in your tax module. But right, we shall be doing this part here as well. So, right, what I'm going to start with here, we are going to be guided by the learning outcomes. What you are expected to know is what we are going to address today. So we need to try and go as much as possible so that you guys benefit on day one. This can help you the whole year, right? So we need to know our learning outcomes. These are the objectives, learning outcomes. What are we expected to know as far as the income taxes are concerned? Students are expected to be able to calculate profit before tax. Right. Why are we expected to know the profit before tax? It is because when SARS is determining the tax liability for the company, they are going to start the calculation of the tax liability with the profit before tax of that particular company. And then they will do whatever they do underneath that. Right. After they've determined the profit before tax, the next thing will be for the students are expected to know how to calculate the current tax expense. Right, so also it means that we will get to know how to calculate the current tax expense today. Students are also expected to know how to calculate deferred tax. So today we are also going to learn how to determine deferred tax for a company. A topic that is scary for many, a topic that is feared by many. It is going to be explained here in detail. All right, students are expected to know the disclosure of the income tax expense, right? In the notes to the annual financial statements, there is going to be a disclosure of the income tax expense. So students are expected to know how to make that disclosure as well. So if you can do the above, good people, if you can do the above, then you are good to go. And finally, you're expected to know the stories about dividend tax, right? Dividend tax, you must be in a position to calculate and generalize dividend tax. Right, that's the summary. IAS 12 is done. So what is needed next is the content of each. Okay, it's not as scary as you think. Right, so let's move. I'll start with breaking down the profit before tax. Profit before tax is calculated where in the profit is calculated is, or actually is found in what? In the statement of profit or loss and other comprehensive income, right? So the profit before tax is calculated according to the accounting rules or standards. So when we are calculating your profit before tax, good people, you are going to calculate it according to the accounting rules. You are wearing your accounting hat. You are not yet with your tax hat. They are not yet doing some funny tax things. You are applying your accounting rules, knowing what to expense, knowing whatever to do that. Okay, let me say corrected, rather. They will give you the calculated already. Corrected profit before tax. So this one is calculated according to this accounting rules. Okay, so for your purposes, good people, you are going to begin with profit before tax as given and adjust for the following. Right, if they ask you to calculate the corrected profit before tax, it means that the profit that we have there is some errors as well as omission. So they are saying take the profit before tax as given, then adjust for errors and omission, and then arrive at the corrected profit before tax. Quite simple. Right, to be applying. Now, for you to know the errors and omissions there, it means that you need to know what your accounting story. For instance, they miscalculated something, you go and correct that miscalculation. On the omission side, for instance, they omitted a certain expense, they omitted a certain income, you go and take care of that particular expense or income. On the errors I gave there, they might recognize revenue before the risk and rewards pass to the what? To the buyer. So for your correction there, you need to what? To go and correctly account for that particular revenue. Quite easy. Right, now we come to the maybe the tricky one, current tax expense. Right, when you are calculating your current tax expense, good people, what you should keep in mind, how you should deal with that question, it is that the current tax expense is calculated according to the what? Is calculated according to the tax rules, according to the tax rules. And these tax rules are contained in the Income Tax Act. Right, so we are going to do that according to the rules of the Income Tax Act. So how do we calculate this current tax expense? We begin with a profit before tax, and we adjust for exempt differences. And adjust for what? Exempt differences. Okay, so that now that leads us to what are exempt differences. That takes us to what these exempt differences are, and we will need now to address them. Okay, exempt differences are also known as permanent differences. Right? It represents income that is not taxable or expenses that are not deductible. Income that is not taxable or expenses that are not deductible. The next thing is we need to know them. So we'll be adjusting for these which are contained or excluded from our profit before tax. But in most cases, they are going to be included in the what? taken into account in determining our profit before tax, the one that is calculated by the accountant above. So now, what are these? Let's see them. Let's see them. Let's talk about them. Right? Non-taxable exempt differences or non-deductible exempt differences. Let's look at that. Non-taxable exempt or exempt income. This is the income that will never be taxed, but the accountant will never include it in the profit before tax calculation. So it means that when we adjust for the purpose of calculating our current tax, we are taking out that income, right? Then we look at non-deductible expenses. Non-deductible expenses, or here we are saying, in other words, I am saying non-taxable income, right? So this income will be included in your what? In your profit before tax calculation. And these expenses would have been deducted in determination of profit before tax, but they are not deductible. But this income is not taxable, right? What is this income? We start. It is dividends, right? Received. It is foreign income. It is foreign income. It is the non-taxable portion of capital gain. You will know it. Go on. Okay. There I have to mute a couple of people. Okay. Right. So we move. Right. So this is our exempt income, good people. And then our non-deductible expenses. We have got fines. We have got penalties. We have got donations. We have got depreciation on administration building. Okay, what else did I leave out there? Anything that I left out with people? Legal expenses, not all of them, right? Not all of them. They will tell you which ones, whether the legal expenses that they gave you are going to be deductible or not. Or they can say the legal expenses incurred and deducted by the accountant amounted to so much, but only this much is deductible according to the tax rules. And then the one that is not deductible, you then have to what? To add it back. All right, interest on penalties, good people. And fines. Okay, so there we go, folks. Then how do we deal with this now? Right, for this one, exempt income, it means that it's the income that the accountant would have included as maybe other income or as a revenue of some sort. But now this income, according to the Income Tax Act, as we have said, is not going to be subject to tax. So as we do our current tax calculation and we have begun with profit before tax, it means that this income is already taken into account. So what do we do now? We need to remove it. So this one is deducted from profit before tax in the what? In the current tax expense calculation. You will have to deduct it. Now let's come this side. The non-deductible expenses. How did the accountant deal with them? Because now, whenever you get to this, you take a step back and think how the accountant dealt with the item in question, and then you are going to reverse the accounting treatment if it's not consistent with tax laws. So these, the accounting would have deducted them, because according to our IFRS, they are expenses, business expenses, we deduct, we don't care. But for tax calculation, they are not going to be allowed as deductions. So what do? These ones are added to profit before tax in the calculation of profit before tax, or in the calculation of current tax. All right, so that's the story there, folks. That's how we deal with this, good people, right? So know your story and deal with these things accordingly. So according to me, you guys, you now know how to calculate current tax. According to me, you have achieved, you have attained that particular requirement, that particular learning outcome, because you now know what the story is. All that you can be waiting for are the numbers, because you don't believe that you know something until there are numbers involved. Okay, right, so obviously then, to make things easy, I'll give you some mini frameworks there, because students like a whole lot of cramming. Okay, let's go to the framework. I'll start with the framework for what? The first one, for profit, corrected profit before tax. I forgot to put it down. I'll start with that one. So we said our point of departure there is profit before tax as what? As given in the question. You paste it down. You then say what? Adjustments. What are we going to adjust for? We are going to adjust for errors. We are going to adjust for omissions. They will tell you the errors and the omissions in place there, but sometimes you have to see them. They won't say this is an error, no. You adjust for these two good people, but there could be many errors, many what. Like adjust for them accordingly. Sign sensitive. Okay. Thereafter, you've got your corrected profit before tax. There you go, folks. There we have that particular framework of yours. Okay. Right. So that's the framework that we keep in mind to enable us to pass this module. Okay, let's take it there. Let's break it here. Okay, right. Now let's go to the next one. The next framework, as we have said, is the framework of calculation of what? Current tax. Current tax. Right, point of departure. Point of departure is the profit before tax. It could be the one that you have calculated, the correct one. Paste it down. And then we said we adjust for exempt differences. Right, what are our exempt differences? For our exempt differences, we said that we have got income that is not taxable, and we have got expenses that are not deductible. We need to adjust them. That income that is not taxable would have been included there, right? Would have been included there, right? We said dividends received. We said foreign income. And we said non-taxable portion of capital gains. You will know about it, don't worry. Time shall come. This is the income side. For income, good people, they would have been deducted, right? They would have been added by the accountant. So to account for them, we have to deduct this. They are not going to be subject to tax because what is going to be taxed is the amount at the bottom there. So we remove them before we get to the bottom so that we don't subject them to tax. On the other hand, we have got expenses that are not deducted. And we have spoken about what? Fines. We have spoken about penalties. We have spoken about interest on fines and penalties, right? Depreciation on the admin building. We have spoken about what else did we mention there? Is the issue of donations and legal expenses, but we'll be careful about legal expenses. Donations, legal expenses, which are not deductible. So they will tell us, you don't have to say which ones are deductible and which ones are not, right? So these ones, because the accountant deducted them, a business expense, and our DOM accountant would have deducted them, but anyway, it's consistent with the IFRS. So what do we do? This we need to add back. Right. So then you get the total of this. Sign sensitive. You put the total there. If the overall is a negative, let it be a negative. Thereafter, you get your what? Profit before, after exempt differences. After exempt differences. All right, there it is. Okay, our framework is not done yet. So I'm going to go there first and expand our stories. Then we'll come and update our framework. So all those items that you are seeing there going through are going to be what? The marks that you'll be earning for the principles. Clear. All right, let's go and update here. We have spoken about what? You adjust for exempt differences. We give the profit before tax and adjust for exempt differences and temporary and movements in temporary differences. So far what we did is we have learned about the about the other part there, which is your exempt differences. So now the next thing that we should bear in mind is the issue of temporal differences. Temporal differences. Okay, someone is saying they're failing to connect. Okay, let me try to connect this person. A second. Sorry, it could be both. Right. So now let's learn about temporal differences for the purposes of determining the movement in temporal differences. Okay. Right. Let's talk about temporal, as the name indicates. Okay. With temporal differences, it means that the treatment by SARS and the accountant is the same. But what could differ is the timing. When does the accountant subtract it or add it? And the amount in question. Like for instance, your prepared expenses, right? Prepared expenses, both SARS and accountant deduct them. But we have got a timing difference in that SARS will deduct the prepared expenses in the period that you pay for that expenses. On the other hand, the accountant, will deduct the prepared expense in the year that the services or goods are delivered. In the case of service, are rendered to the company. So that becomes what? It's a timing difference. That's the temporal difference, right? Sooner or later, both parties are going to what? To deduct the amount in question or to tax the amount in question, as opposed to the exempt differences. Exempt differences are permanent difference. This is not taxable, this is not deductible, period. But with temporal differences, the accounting and the tax treatment are the same. But what differs is when is the item in question deductible or taxable for tax purposes, or expensed or included in other income by the accountant. Income received in advance, right? According to your tax knowledge, income received in advance is gross income, because gross income definition is what? Total amount received. You put in bold received. If you receive an amount, SARS will tax you on the virtue of you having received it. Even if you say, hi, but SARS, it relates to services that you rendered in 2030. The fact that you received it, they say put it in gross income. But now we jump to the other side, the accounting treatment. For the accounting treatment purposes, SARS is going to say that, accounting treatment. The accountant is going to say, this is income received in advance. We are going to render these services in the future and not now. So we don't include it in our statement of profit or loss and other comprehensive income. So those are examples of temporal differences. Also, this also translates to capital allowances, right? Capital allowances, rather the tax value and the carry amount. The carry amount of an asset is calculated in a certain manner, right? The accountant can choose to say, okay, we're going to write off our vehicles over a period of 5 years. But if you go to interpretation note 47, maybe SARS says that now they should be written off over 3 years. So because of that, we have the difference between the carrying amount and the tax base. That will give rise to a temporal difference. But in the long run, if you are to look at it, the cost of those particular assets will be deductible in full, but over different periods of time. SARS, if it says 3 years, it means that now they will allow for the deduction in full sooner than the accountant, who may maybe say we are writing them off over a period of 5 years. So those are what are temporal differences, right? They arise as a result of what? A timing difference. There's a timing difference. When do we deduct something? Timing differences, right? These arise as differences between carrying amount of an asset or liability, and its tax base, right? So I wanted to know that now temporal difference arise on items that are included in the statement of financial. So if you are looking at something, good people, and say, okay, does this trigger temporal difference? You have to look at it and say, does this thing sit in the statement of financial position? If it's a yes, then it has got a potential of what? Of triggering a temporal difference, thereby giving rise to deferred tax. Okay, so that's the adjustment that we need to make on our way to the calculation of what? Of current tax. So let's go. So now with the movement in temporal difference, it is the movement in temporal difference balance between what last year and the current year. It is the one that we are going to show in our current tax calculation there, because we said we adjust for exempt differences, of which you now know them, as well as movements in temporal difference, of which I've just told you what temporal differences are. Then the movement is the difference between the temporal difference for this year and the temporal differences for last year. That's that. All right. So you come here and say movement in temporary differences. Okay, it's also sign sensitive. I'll explain this shortly. Movement in temporal differences, you adjust for them there. They are sign sensitive. I will tell you what that means. Then you get this total. This total, good people, has never been given a name. Right. Thereafter, you say less assessed loss. If there is any assessed loss, you then deduct it here. Then you get your what? Your taxable profits in the case of the profit. Let me do this. Then you get your taxable profit or assessed loss. This is the assessed loss brought forward for previous years. Taxable profit. Then you say, oh, current tax. It could be at 28% or 27%. The question will indicate, right? The question will indicate. Then you get your what? Your current tax rate. All right. Okay, so if the question was the current tax due, it means that there are provisional taxes that have been paid. Like make first provisional tax. That's when you come here and say less provisional tax payments for that year. Right, this is the tax that has already been paid in advance. The tax that has already been paid in advance. Thereafter, you get your current tax due or refundable if the provisional taxes are more than the liability. Liability, the refundable one, will see it by having a negative there. All right, so that's how it is, guys. Now you've added new knowledge that you did not know, the calculation of current tax. Okay, so we are moving forward. Okay, now I want to explain the issue of movements in temporal differences. Right, movement in temporal differences is the difference between the temporary difference of current year and temporary differences for prior. Right. Now, for the purposes of our current tax, the sign will have to change. Right. So for the purposes of current tax calculation, the movement in temporary difference changes sign. I'll explain this. I don't want to get mathematically, that would be crazy. So if you have got a negative movement, it means that your temporal difference are deductible. When you go to your deferred, to your current tax calculation, you're going to say, okay, they are deductible, but they are deductible in the future and not now. So for now, you get tax on that amount, they will be outside the bracket. if they are taxable temporal differences, meaning that now they were outside the bracket, you need to take a step back and say taxable, but when? Taxable in the future. So when you go to your current tax calculation, you go and what? And deduct them. Okay, so you will see that on practical. It might sound great for now. So here I will say taxable. Let me explain the issue of this. Temporary differences. Temporary differences are either taxable or deductible. Right, what do we mean by that? Taxable in the future, deductible in the future. So that's why we have to do the what? The sign change thing in our current tax calculation. All right, so we are going to see that we need to do a question before what we end today's class, so that you guys will go out there with valuable knowledge that makes sense, not to say, I know the current text or I know IS-12, but I only know what, I only know the theory. Right, our eighth there could be, what gives rise to a taxable temporal difference? Taxable temporal difference, but I can insert a thing there. This is how we get the taxable temporal difference or the deductible temporal differences. And this, unfortunately, good people, you need to know it by head. And know it by head, if you're clever, I'm saying you need to cram it until it becomes part of you, second nature. Taxable temporary differences, how do they arise? And deductible temporary differences. This confuses even a chartered accountant. They cannot just say it on top of their head. They need to first say, what did you say? All right, so this is how it arises, good people. A taxable temporal difference, let's start with this one. A taxable temporal difference arises where, in the case of an asset, right? In the case of an asset, the carrying amount of an asset is greater than the tax base. This will give rise to a taxable temporal difference. In the case of liabilities, good people, right? It will arise when the carrying amount of a liability is less than the tax base. This side, deductible temporal differences will be the opposite. In the case of an asset, it means that your carrying amount of the asset is less than the tax base. In the case of a liability, liabilities, it means the carrying amount of that liability is greater than the tax base. Remember, carrying amount is calculated, determined according to accounting rules, and then your tax bases are determined in terms of what? In terms of tax. Okay, so we shall see what we mean by that. In case for now, it's still Greek. Okay. I'll show you how it is there. All right, let's bring our framework this side. Let's bring our framework to this side. Okay. All right. Excuse me to take that. Remove this. Okay, so at this stage, I can take questions so that I don't run with confused people. Okay, so any questions, good people? Asking is for free. Free. Okay, carry amount is cost minus accumulated depreciation tax base is cost minus capital allowances. But we do have some other items that we have the tax base and whatever temporal differences without you having claimed the capital allowances. I'll give you an example. of prepared expenses, they trigger what? They have a tax, there's a carrying amount, because in the balance sheet, they'll be having a certain amount. Right? For tax purposes, the carry amount of a prepared expense will be 0, because there will be nothing that will be deductible in the future. Just get some examples of temporary differences. Okay, I'll put them high up there so that when you see the framework, you know it's the last thing that you are dealing with. Examples of temporary differences. Other ones. Right. It could be this one. You see this. It could be your prepared expenses. They'll give rise to temporal difference. Why? Because the carrying amount will be equal to an X amount, and the tax base will be equal to 0. Right? But both accounting and tax allow for the deduction of expenses. Okay, so here we can all see that therefore the carrying amount of an asset of a prepared expense and the tax base are not the same, but the expenses are both deductible. Hence we say they are what? Temporal differences. Okay, income received in advance. I'll explain, okay, I'll have to go back and explain the received in advance. Let me explain what we mean by tax basis here. It is because USARS will allow you to deduct the prepared expense in the year that you pay for it, thereby leaving a tax base of 0. Nothing will be deductible in the future. But with an accountant, prepared expense, you put it in the balance sheet and say it is going to be deductible in the future. In the balance sheet, financial position, there you find balances. There you find carrying amounts. Okay, income received in advance. How is it treated by the accountant? It is put in the balance sheet with an X amount. What will be the tax base? The tax base will be 0, because USARS will tax you in that income in the year that you receive it, and then case closed. Okay, so provisions also, right? You have a certain carrying amount, and USARS will say the tax base is 0. But with these provisions, I want you to know that USARS is saying that they are not actually incurred. It is an expense for the future. You did not pay for this. You just provided for it. You just put money aside. It is not actually incurred. So SARS will not allow for this deduction of these provisions. You will see a lot of funny things, provisions for warranty cost, provisions for this and that. And then they ask you to calculate the current tax. It is because of that. All right. Other thing that I want us to talk about here before we can maybe do a question. Okay, so I can go there and that on the framework. But let's talk about the deferred tax, and then we can do a question. After that, we'll see if it allows us to go and do that other one. Because too much theory also can be a nightmare, because you'll be still fantasizing there as to say, what will we use this for? Deferred tax. To defer good people is to postpone, right? This is a future tax, right? Now, this is a tax that is going to be payable in the future. And now what gives rise to a deferred tax is temporal differences. Temporal differences give rise to deferred tax, right? And when we say temporal differences now, remember we said that they carry a charge. Taxable temporal differences. It means that now you will be taxed in these temporal differences in the future. Yes, we say that they will give rise to deferred tax liability, right? We were going to pay tax on the taxable temporal difference because we'll be taxed on those amounts. What about deductible temporal differences? These are going to give us a tax advantage in the future. That's why we say that the deductible temporal differences, they give rise to deferred tax asset. All right, so that's the story that we should actually familiarize yourself with them, because it is going to be a nightmare. All right, so as you can see that now, when we do our deferred tax, we are dealing with temporal differences. So it means that now this movement in temporal differences, good people, it is found in the deferred tax calculation. This one is determined in the deferred tax calculation. So what do we mean by that? It means that, good people, when we are dealing with the calculation of our current tax, we must have done our deferred tax, because there is no way you can calculate your current tax before you determine the deferred tax, right? Because in the deferred tax calculation, that's where we are going to get the movement in temporal difference, which is part of our current tax calculation, right? So we should know about that. But in most cases, they are not cruel in the exam, right? They will basically tell us, part A, calculate the profit before tax, part B, calculate the deferred tax, part C, calculate the current tax. Meaning that when we get to our part C, we're already armed with the what? With the movement in temporal difference. Because in that very same deferred tax calculation, which is in the tabular format, you are also going to get your temporal differences for last year and for this year, and then you will work out the movement. Okay, so in a nutshell, that's the story of deferred tax. That's the story of deferred tax, as short as it is. But it's a nightmare for men, but you'll be exempted from this nightmare because we will do it. Okay, so right, I'm not going to go to the disclosures now. We'll see them when the above knowledge has been absorbed. As far as dividend tax is concerned, I'm not going to tackle it today. Right, so maybe I can take questions, good people, as far as the profit before tax, current tax, and deferred tax are concerned. If there are no questions, then we need to do a question. Make sure that this knowledge, good people, keep it in your head. It will serve you a lot. There's a question that we shared there. So we'll go through that question together. Are there any questions, good people? If there are no questions, let's see how we are going to be tested in the exam. Right. I shared a question there with you guys. Right. They say start by required. That's universal. Right. So if you are doing this for the first time, you need to listen very carefully so that you are not left out, because there are some frameworks that will follow. I didn't do the deferred tax framework. It's quite a lot. This one. You'll see how funny it looks like. Right. This is the question that I want us to do. Right. And this is the required. Let's look at the required first. The required says of the list that the donation made to animal or whatever should be capitalized. Okay, we'll look at that. Conceptual framework, we'll study data. Then they say prepare all the necessary. We'll do the journals later. That's revenue. And then our questions today is C, D, and E. right? And F, so by the end of the day today, you're doing everything, almost. Calculate the correct profit before tax in the statement of profit or loss and other comprehensive income of Forfeit Limited for the year ended 30 June 2012. Take into account all the above mentioned information. You are going to depart with profit before tax as given. You then adjust for what? Errors and omission, which we are going to see in the question. Sharp. D, calculate the deferred tax balances in the statement of financial position of Forfeit Limited at 30 June 2011 and 30 June 2012 using the statement of financial position approach according to the requirements of IAS 12 income taxes. Indicate if your answer is a deferred tax asset or a deferred tax liability in the statement of financial position. 10 marks. You will know it by the end of the day. Calculate the current tax due. This is what we pay over to SARS, so it's after the provisional taxes have been taken into account. To the South African Revenue Services by forfeit for the year ended 30 June 2012. Use the profit before tax in the statement of profit or loss and other comprehensive income as calculated in C above as your starting point. The movement in temporal differences in the current tax calculation should be calculated using the statement of financial position approach. I will show you that. The movement in temporal differences. All right, so we start with our question. And we can paste down our framework, and then we do now what needs to be done. Okay, what did we agree? We agreed that our profit before tax for the purposes of our required C, this is our required C. We start with profit before tax, the one that is given, and then we are going to make some adjustments. Right now, you don't have to say adjustment for errors and whatever. No, we just have to watch to take it as is. All right, let's go through the scenario together. Forfeit Limited is a well-diversified company that manufactures and sells a range of animal products to various supermarkets, pet stores, and veterinary clinics. The annual financial statements of Forfeit Limited for the year ended 30 June 2012 were presented to the Board of Directors for authorization for issue on 15 August 2012. The following are extracts from the draft financial statements of Forfeit Limited for the year ended 30 June 2012 before taking into account the additional information below. Statement of profit or loss and other comprehensive income for the year. Profit before tax referred to note number 1 for 2012 is 940. So that becomes our point of departure. We are doing 2012, 940. So that one contains errors and omissions that we need to adjust for. That's become the point of departure. So if you are going to write that as number 1 there, the marker will really know that this person knows what he's doing. Let's go. Okay, need to do some little bit of muting. Those who are not muted. Experiment sound. All right. A statement of financial position as of 30 June 2012. Manufacturing equipment carrying amount, right? Refer to note number 2. Inventory, also there. So that we have got a machine there. It has got a potential of triggering deferred tax, we shall see later, because it's an asset, it sits in the statement of financial position. So if the carry amount and the taxes are not the same, then that item will trigger deferred tax. We go to inventory again. If the carry amount and the tax base are not the same, it will trigger deferred tax. Let's go to the manufacturing machinery note first. Okay, so to start with, we're supposed to go to note number 1 for the purposes of what? Of profit before tax. Profit before tax includes the following items: income, revenue, note 1.1, foreign income received from them, there it is, note number 1.2, expenses, depreciation manufacturing equipment, right? Don't know it. Repairs to water pipes, 17, donation animal rights national conference, not taxable, refer to note number 5. Let's go to note 1.1 for the purpose of revenue. Revenue includes an amount of 90,000 received on 1 June 2012 from a new pet shop that recently opened for an order of various animal food products. Okay, our year ends 30 June, so listen carefully. Due to a backlog of orders, the animal food products were only delivered to the new pet shop on 10 July 2012. So what I want you to see there is that this money was received in the 2012 financial year 1 June, but these goods, these pet food, were only delivered in the following year. So are we supposed to include it as revenue in the current year? We are still wearing our accounting hats. No, this is income received in advance. It was received in 2012, but the services were already rendered in the following year. So that income must be separated here, right? Here, we need to remove it. Income received in advance. We need to remove it. Relating to food. They said something like it was included because they said revenue includes, it does not support, it's not supposed to be included there. Not at all. Because the services were rendered the following year. We know this from account. For feed, sells all its animal food products at gross profit percentage of 20% on cost price. For feed, transfers control of the animal food on delivery to the new pet shop. Okay, so now what that means is that we also have to deal with the cost of sales element relating to those goods that will be rendered in the following season. Cost of sales, right? As far as cost of sales are concerned, right, they were separated when the revenue relating to the supply of the 60,000 was actually what taken into account. So what do we do to correct this? There's no sale of 60,000 pet shop that took place in the current year, but who accounted is already deducted, is already taxed 60,000. So obviously it's already what deducted the cost of sales relating to that 60,000. Yet there was no transfer of what risk and rewards in the current year. So we need to reverse the cost of sales. They were deducted. We need to add them back. We have the gross profit of what 20% on cost of sales. So it means that now to get the actual cost of sales, you say 100 divided by 120. I hope you know this fraction. If you don't, then don't worry. We will know it as we get serious, as we progress. So to get the cost of sales relating to the 60,000, given that you apply gross profit margin of 20%, you simply say 100 divided by 120. If it was 30%, you can say 100 divided by 130. So let's see, and we need to add back this amount because it's an expense that was deducted, yet it's not supposed to be deducted in the current year. So there we go, folks. That's how we correct that error. Okay, we move on. 1.2. Foreign income received from cattle food sold to the Minister of Agriculture in Zimbabwe as part of the livestock feeding program is not taxable in South Africa in terms of a double tax agreement. For feed, paid foreign taxes of 36,000 on this income. This is foreign income. We are calculating profit before tax. We are still wearing our accounting hat. So we agree with the accountant that he included it as other income. He included it as part of other income. But when we go to the current tax calculation, that's where we are going to differ with the accountant. So that's a typical exempt difference, but we're not interested for now. Depreciation, note number 2. Our depreciation note number 2. They said note number 2? Yes. During the current financial year audit, the directors discovered that the repair cost incurred on 30 June 2011, that's last year, to repair the manufacturing equipment damaged while it's moving it were incorrectly recorded in the general ledger. It was allocated to the manufacturing equipment account instead of the repairs expense account. The total amount of 40,000 debited in the manufacturing account general ledger account consisted of the following, right? Repairs cost as well as the VAT. So this is a prior period error. That's our IAS 8. We are going to look at our IAS 8 as the syllabus what continues. But what we have to take note there is that the cost of our manufacturing equipment is overstated with an amount of what? 40,000. It is overstated with an amount of 40,000 because they performed the repairs and maintenance on the machinery. But what did they do? They went on to capitalize that amount. So when we calculate our depreciation, because it was left to us, they put a question mark, we need to first remove the 40,000 on the cost. So that repairs expense should not be capitalized. Let's move. Manufacturing equipment is depreciated according to the reducing balance method at 20%. During the June 2012, the directors decided to change this method to the straight line method and estimated that the remaining useful life of the manufacturing equipment is 4 years. Okay. The residual value of the manufacturing equipment remained unchanged at need. The South African Revenue Services allows a capital allowance of 5 years on the manufacturing equipment according to the straight line method. So we are seeing that the manufacturing equipment also, there's going to be some deferred tax implications because the write-off period according to SARS does not agree to the write-off period according to the accountant, but deferred tax later, not now. Deferred tax later, not now. Okay. Right. We move. So we have the story. At incorporation of the company on 1 July 2009, all manufacturing equipment were acquired at a cost of 500,000 and immediately put into use. The tax value of the manufacturing equipment on 30 June 2011 amounted to 340,000. 30 June 2011, that's the beginning of the year. That was the tax value. No depreciation charge for the current year has been recorded yet in the accounting record of FIT. They have not recorded any depreciation. So what do? It's an omission. We are going to do it. No other manufacturing equipment were acquired or sold since incorporation. The South African Revenue Services indicated that they will reopen the previous year's tax assessment and will issue a revised tax assessment in respect of the 2011 tax year. The South African Revenue Services also agreed to refund an input, a VAT input of 521, not claimed by forfeit in the previous year. All right, so the story for here is that, good people, the depreciation for the current year is not taken into account. Right, so it means that we need to work out the depreciation for the current year. Okay, so here there's another concept. There's an incorporation of IAS 8, of which I'm going to explain. The write-off period was initially 20%. 20% it was 4 years. But the directors here, there was a change during the year, right? So given that they were bought in 2009, stuff like that, it means that their remaining useful life was now at 10, 11, and 12, it was 2 years or something like that. But in the current year, the director said, no, not 2 years. The remaining useful life is 4 years in the current year. So what does that mean? That's our IAS 8, which I'm going to explain briefly, but we'll also get to it when we actually move on seriously. So it means that whenever there's a change in estimate, the rules are the depreciation for the current year will be based on the remaining useful life. The depreciation for the current year will be calculated on the carry amount at the beginning of the year. So what does that tell us then? The depreciation, because there was a change in estimate here, we need to get the carry amount at the beginning of the year. That's what the standard says. And we need to get the what? The remaining useful life. That's IAS 8, this one. Right, that's the rules of IAS 8, which I will make you claim when we eventually start with our IAS 8. Is the rules. Those are the rules. IAS 8. They say that the depreciation of the asset, whenever there's a change of the estimate, meaning to say there's a change in the remaining useful life, there's a change in the depreciation period. We are going to work out the depreciation for that year based on those two, on the carry amount and the remaining useful life. The depreciation will be the carry amount divided by the remaining useful life. The directors have told us that the remaining useful life is 4 years. All that we need, good people, there is the carrying amount. So we have identified the remaining useful life to be 4 years in 2012. So we need now to get the carrying amount at the beginning of the year. Right, the carrying amount at the beginning of the year, we have this. There is the carry amount at the beginning of the year. Beginning of the year, we are looking at the carry amount for last year. It's 360. So I want you to remember this, that it's 360, yes, but there was that error where they capitalized the amount of 40,000, which is not supposed to be capitalized. So what do? We correct that. Remove the 40,000, which should not be part of that cost. Then we have a carry amount of how much? Of 320. Then apply your knowledge of IAS 8. 320,000 divided by 4 is the depreciation. Depreciation is subtracted. Okay. I don't know if that is too much. I can take questions on that one. I would understand if there is a couple of confusion. Questions, good people? You can unmute and answer your question, or you can raise a hand and I'll unmute you in case you can't. Remember, this is for you guys. Free class, make maximum advantage of it. And from here, you may decide not to even attend classes. Question? Okay. If there are no questions, let me continue. Okay, are we together? Are we following? Okay, there is a question there. You can. Okay. Yeah, you can.
I said.
Yes.
Please, man, can you just repeat how did you get the depreciation on machinery of 80,000? Can you just please repeat the process?
All right.
The calculation, please, man. I'm just got lost with all the numbers. If you can just repeat it, I'll appreciate it a lot. Thank you.
All right. Ciao. Okay. It all begins from the scenario there. Okay, I'll quickly go through where the scenario is. Okay, I understand where you're coming from. It's because we incorporated some rules of IAS 8. Here's the story. Our equipment, they told us when it was bought and they gave us the write-off period, which was 20%, that's 5 years. But then we are told here that during the 2012, the directors decided to change this method to the straight line method and estimated that the remaining useful life of the manufacturing equipment is 4 years. So at the beginning of 2012, the remaining useful life is 4 years, right? So there was a change in estimate because initially the write-off period was 20%, which is in years is 100 divided by 20 plus 5 years. And then they say it's now changed to 4 years. That's a change in estimate. And there's IAS 8, an accounting standard that deals with change in estimate. Depreciation rate or write-off period and residual values are referred to as estimates. And whenever they change, IAS 8 says that now the depreciation for that asset where there's been a change in estimate should be determined as follows. Ascertain the remaining useful life of that asset, right? ascertain the carrying amount of that asset at the beginning of the year. And then the depreciation for that year should be the carrying amount at the beginning of the year divided by the remaining useful life. Right. So I do identify the carrying amount at the beginning of the year, and I do identify the remaining useful life, which was given. And the carrying amount at the beginning of the year, if we are to go to it, they say here in the statement of financial position that this is the carry amount for last year. Remember, the carry amount at the beginning of the year, it is the closing carry amount for last year. I picked this carry amount for last year. And then I came also to the note here. I'm told that last year they made repairs to the machinery and they capitalized an amount of 40,000. What does your IAS 16 say? The repairs cost, we don't capitalize them. So it means that this carry amount that we have last year of 360, it is overstated with an amount of 40,000. Take out the amount of 40,000 so that we do get the correct carrying amount. So I separated, I got the correct carry amount of 320. Then I said back to IAS 8. The depreciation for the year, whenever there is a change in estimate, it is the carry amount at the beginning of the year, which I have now, 320, divided by the remaining useful life, in this case, 4 years. That's how I got to what? To 80,000. I had to bring in my knowledge of IAS 8, of which we're also going to do it together. I don't know if we are fine there. Are you answered?
Thank you, sir. I understand now. Thank you for explanation. Thank you.
All right, sharp, sharp. Right, then we continue with our notes. Right, repairs, we have repairs note 3. There is note 3 for the repairs. During the first week of July 2012, it was discovered that cat food inventory with a cost price of 210,500 was moldy and could therefore not be sold to customers. Okay. The inventory balance became moldy as a result of a water leakage caused by burst water pipes in the leased inventory warehouse during June 2012. The inventory of 210,500 was included as inventory in the statement of financial position of for FEED Limited as at year ended 30 June 2012. Okay, so there is inventory that cannot be sold now, destroyed by water, but they included it in the financial statements. Okay, so what is happening there, good people, is that we have to write off our inventory with an amount of 210,500. Inventory write-off. Inventory write-off, good people, is treated as an expense. If you are to write off some inventory because it cannot be sold, you are allowed in terms of the IFRS to deduct the cost of the inventory written off, right? And inventory write-off, the journal is you debit the inventory write-off, debit of profit or loss, and credit the inventory account. So this inventory write-off that we have to make, because it cannot be sold, we have incurred what? A loss. That loss is treated as an expense. We need to expense this amount as the inventory write-off. Okay, so we'll come here and say inventory write-off, we expense it. They did not expense this write-off. The amount of 210,500, we are allowed to expense it. We do just that. Okay, that's the first part for the multi-inventory that cannot be sold. In June 2012, FEED Limited paid 17,000 for the repair of these water pipes in the warehouse. Due to the damage caused by the burst water pipes, it is probable, but not virtually certain, that the landlord of the warehouse will refund for FEED for the repair cost incurred. Okay, so they are the repairs costs that were incurred. They didn't say that they were not recorded. They were recorded because if you check here, they told us that expenses 17,000. So those were recorded. What was not recorded was the inventory write-off. There. So we're good there. No problem. Right, we got donation animal feed, national conference, not tax deductible. Note number 5. On 31 January 2012, FEED Limited donated 110 to the Animal Rights Conference, which was held in June 2012 in Bloemfontein and recorded it in the accounting records of Forfeit Limited as donation paid. It was recorded, we're good. We are still wearing our accounting head. So let's not say, donation is not deductible. No, we are not calculating our current tax expense yet. So we leave it there as a deduction. We could. All right, so we don't have any reference to any note. We go to our note 6, 7, and whatever etc. Then we conclude. Let's see how this might affect. On 15 January 2012, Forfeit Limited received a claim of 500 from the Benford House Racing Club after one of its champion race horses died during a horse race. The horse racing club alleged that the horse died as a result of the horse feed it ate, which was produced by Forfeit Limited. Initial tests found traces of toxic substances in the specific batch of horse feed. At year end 30 June 2012, the lawyers of Forfeit Limited are of the opinion that it is not proper that Forfeit Limited will be found liable for the claim. So, right, this is for the other what required. Whether we'll be required to know whether there's a contingent asset, contingent liability, whatnot. A claim of 110 was also received on 30 January 2012 from Mr. K. A frequent horse racing gambler. He alleges that his gambling earnings were limited as a result of the death of the above mentioned racecourse. At year end on 30 June 2012, the legal advisors of Forfeit Limited are of the opinion that the probability of the claim received from Mr. K of being successful is remote. Is for another note, we will be required to discuss whether the contingent asset, a contingent liability, provision, you name it. There we'll be able to answer that one after we have done our IAS 37. We move. Number 7. South Africa, the SA normal tax rate remained unchanged at 28%. The company provides for deferred tax on temporal differences according to the Determinant of Financial Position approach. There are no other exempt or temporal differences except those mentioned in the question. There is certainty beyond any reasonable doubt that the company will have sufficient taxable profits in the future against which any deductible temporal difference can be utilized. Okay. Just give me a tax rate. Forfeit Limited made the following provisional tax payment for the year ended 30 June 2012. These are the provisional tax payments that were made. These we are going to take them out from the current tax expense so that we can determine how much tax is still due to SARS. Ignore all VAT implications except for the additional information provided in Note 2. Forfeit Limited is a registered VAT vendor. All amounts, assume all amounts to be material. Okay, fine. We don't see any other thing that affects our profit there. So we can then go and close off that one and get our what? Our correct profit. Our corrected profit. This becomes our corrected profit before tax. This is our corrected profit before tax. Remove. So that one has been answered. Our required C has been answered. So this I would say required C. Right, I doubt we've got any question there. We're able to identify the errors and omissions. Let's go to our required D now. Right, let's look at required D. Required D is calculate the deferred tax balances in the statement of financial position for Forfeit Limited at 30 June 2011 and 30 June 2012 using the statement of financial position approach. So you will see the framework here could be in determining our deferred tax could be both. You will have your details here about what the thing that trigger deferred tax, your assets and liabilities, and you state the carrying amount there, and you state the tax base there, and then we have our temporal difference there. Right, now it is important that when it comes to temporal differences, state whether it's taxable. It has to be outside the bracket if it's taxable, and it's gonna be inside the bracket if it's what? If it's deductible. We need to see that because that will have an influence on the deferred tax that we have there. Whether the deferred tax will be an asset outside the bracket, or it's going to be a liability, which we'll see as being inside the bracket. As being inside the bracket. Yes. So this is our framework, more of. It looks like this for deferred tax calculation. That's our framework for deferred tax. All right, we are going to start. Remember what we said. The things that sit in the statement of financial positions are the ones that trigger deferred tax, provided their carrying amount and the tax base are different. So we are going to bring here the things that sit in the statement of financial position whose carrying amount and the tax base are not the same. You might wonder. So let's go. Right. Moving from here, because we don't want to leave anything. This sits in the statement of financial position, manufacturing equipment. So we need to determine, is the carrying amount and the tax base the same? The answer to that will definitely be no, because of what we have here. USA's write off the assets over 5 years. As initially it was okay at 5 years, but for some reason we changed it to 4 years. So the write-off period, the carrying amount and the tax base are going to be different. So manufacturing equipment will trigger deferred tax. That's it. And we have to write here, manufacturing equipment. Right. Let's go there. Let me say working one at the bottom. Here I can say my working one. Oh, okay. This is okay. By the way, sorry. By the way, we are starting with last year. Last year. We are doing this for June, for purposes of June. Last year. June. Last year. So it's 30 June 2011. I think this is given. We simply have to go here. 30 June 2011. The carrying amount is given 360. So we put it there as 360. Let's see if it's different from the tax base. If it's the same as the tax base, it will not trigger any deferred tax because no temporal difference will arise. Let's go. I remember they gave us the tax base for the beginning of the year or for last year. I remember they told us somewhere here. The tax base of the manufacturing equipment on 30 June 2011 amounted to 340. 340. Where am I writing this? It's 340. Right. Now, guys, we have a difference of what? A temporal difference of 20,000. But if you are simply going to say temporal difference is 20,000, you didn't say anything because the temporal difference is a charge. Either it's deductible or it's taxable. So now what I would do is I would take a step back and say, I have a situation where the carrying amount of an asset is greater than the tax base. Do I have a deductible temporal difference or do I have a taxable temporal difference? That was done in class. I will simply go to my tab. I say, okay, carrying amount of an asset is greater than the tax base. I have a taxable temporal difference. So I go there. I have a taxable temporal difference. A taxable temporal difference should be outside the bracket. Then I say 360 minus 340. Taxable outside the bracket. Now I have to go now to determine whether it be a deferred tax liability or asset. This is determined at 28% tax rate. Now I need to take a step back again, right? And go back to my notes and say, taxable temporal difference. Will it give me a deferred tax liability, the liability of which should be in bracket, or will it give me a deferred tax asset? So that's the challenge that most of the people face, students that end up making them to hate deferred tax. So I'll come here, good people. These notes also, I told you because I'll be knowing what is to come. Okay, so here we say taxable temporal difference gives rise to deferred tax liability. So it means that we have a deferred tax liability, we have a negative number there is equal to minus 20,000 times 28%. That's a liability. As you can see, it's a negative. Rather in brackets. All right. Any questions there? Because going forward, will be now on 360. Assuming that you guys now, you know. Do you have a question with how we move from left to right?
No, thank you.
Okay, sure. Right, we move on to the next thing because we don't want to leave out anything. From the top there, things that sit in the statement of financial position are the one that trigger deferred tax. So I only take breaks when I come across something that sits in this statement of financial position. Inventory. Okay, inventory, don't worry. It's IS2, law of cost and net realizable value. Even in accounting is the tax and accounting is the same. Even SARS will allow for the write-off and stuff like that. We come here. Profit before tax. Now, these things, they sit in the statement of what? Of profit or loss. So they will not trigger any what? Deferred tax, and we don't have any provision. Okay. We come here. I don't see anything. Where are we? The revenue, this one. This prepayment, it took place in 20, income received in advance. It took place in 2022, so last year, does not affect. Foreign income item does not affect, unless if you receive in advance. These are the errors that were made, affected our manufacturing equipment, which they clarified to us. And then, I think I skipped number 4 when we were reading there. And then here, the cat food write down happened in 2020, whatever. No problem. It's not a balance sheet item. Then number 4. Number 4, I skipped it when we were talking there, when we were going through that one. But let's see. The balance of the allowance for credit losses in the statement of financial position of forfeit limited on the respective dates are as follows. Last year, 40,000. This year, 31,000. All right. The allowance for credit loss, good people, it also sits in the statement of financial position because it reduces our liability. Sorry, it reduces our trade debtors. So it has got a potential of triggering deferred tax. You find it in the statement of financial position, reducing our trade receivables. Let's move. The South African Revenue Services allows 25% of the allowance for credit losses as a deduction. Actual credit losses are written off directly to the statement of financial, direct statement of profit or loss and other comprehensive income, and not against the allowance for credit losses. All right, this will trigger deferred tax because we are saying the balance for allowance for credit losses. Our accountant is saying it's 40,000. USAS is saying no, we only allow 25% in future. So this will trigger deferred tax for the previous year. Right? I can say within 1 year. Who accountant says the allowance is 40,000, right? In the statement of financial position. SARS is saying no, we allow 25%. So according to SARS, the taxpayers or the amount of the allowance for credit loss is 10,000. So I put it there. Right. And now, when it comes to allowance, we need to be very careful and very clever. That's what makes this module a nightmare to man. Classification of the allowance for credit losses. Because at the end of the day now, when we need to determine whether it's a deductible or taxable temporal difference, we need to say, is it an asset or a liability? It has to be classified amongst those two. Either it's an asset or a liability. Our temporal differences with people, either deductible or taxable. And to determine whether it's deductible or taxable, we need to look at whether it's an asset or a liability, and whether the tax base or the carry amount is less than or more than our carry amount. So let's think about this. Very technical. Now, allowance for credit loss. I need to say whether they're an asset or they are a liability for the purposes of my deferred tax. Allowance for credit losses, good people, they reduce our debtors. They reduce our asset. Anything that reduces your asset, good people, is a liability. So when I look at the allowance for credit losses as an accounting student, I am seeing a liability. So my conclusion here is that we have got a carry amount of a liability, which is greater than the tax base. What do I have? Do I have a deductible temporal difference or a taxable temporal difference? I come here. Carry amount of a liability is greater than the tax base. I have a deductible temporal difference. I have a deductible temporal difference. So if you failed, to say that now, if you failed to plot that allowance is either an asset or a liability, that would be the end of you. That would be the end of you. View it as a liability. View it as a liability. There. View it as a liability because it reduces our asset. Right? Carry amount of a what? Of a liability rather than tax base, we've got a deductible temporal difference. I come here, deductible temporal difference, it means that I should have it as a negative or in brackets. A deductible, now I have to go to the deferred tax column there. A deductible temporal difference will give rise to a deductible temporal difference will give rise to a deferred tax asset. So here I should have a positive number. The tax portion should be like that outside the bracket. So this is something that good people you should practice. I know it's very tricky for students. You have to internalize this. Right, we have to internalize this. We have to internalize that knowledge. Make it your second nature. We don't want you to be cramming it in a painful manner. All right, let's move. Assets and liabilities. I don't see anything that will trigger deferred tax in the previous year. Okay. Donation, no. Claim, no. Yeah, basically for last year, those are the things that trigger our deferred tax. Now look at the total. But the last two good people must be total always. The last two must be totaled like that. So you simply total your last two, your temporal differences, as well as your deferred taxes. Okay, so I've totaled the last year. Right now, we come to current year, 30 June 2012. Right. I will scan again for 20 June 2012. I will still put people run like this, looking for things that sit in statement of financial position and stop and think about them. Right, we have got manufacturing equipment carrying amount for this one. Obviously, it's different from the tax base, even we say it is the same. So I need to come here, could be, and say my manufacturing equipment. Right, we need some calculations here. We look at the what, at the carrying amount, we look at the tax base, if they are the same or not. If they are the same, not deferred tax, I'll go and remove them. Carrying amount, if you remember, the carrying amount, good people, at the beginning was 320. And we had a depreciation of what? Of 80,000. Meaning to say that the carrying amount now in 2012 is 240. Now, what about the tax base? Let's look at the tax base. The tax base, we had a tax base at the beginning of the year of 340, if you remember, 1,000. And what did they tell us? They told us that the capital allowances, good people, are claimed over 4 years. The capital allowances are claimed over 4 years. And we were told that these machineries were bought for an amount of 500,000. So USA's claims over 4 years. So I would take that cost of 500,000. I would divide it by 4 in order for me to get the capital allowance for what? For 2012, which I separate from the balance at the beginning of the year. There we go, guys. So this is the tax base. This is the tax base. This is the carrying amount, right? Did we do it right? Tax base 4 years, and they said SARS allows the write-off period over 4 years. On cost, how did we do the SARS issue? Okay, SARS 340, and this 340 for SARS basically at what? It at that. Should it be 300? Okay, I'm thinking about how they treated that one. The one for SARS 340 included that one. 4 years on the write-off over 4 years. Okay, 340. SARS, they said at the beginning was 340, but it was because they had capitalized that one. They said 340. Everything that was capitalized here. The carry-up was 340, and there was an amount of 40,000 that was what included. That was capitalized as repair. So we say 340,000 minus that. And this one, did I calculate it? 4 years. Yeah. 40 minus 40. 340 minus 40. This is 300. Good people. Sorry. This is 300. Then 175. Okay. So our carry amount should be 175. Our tax base should be 175. So we go there, we update to 40. Carry amount 40, tax base 175. Right. So now we need to think about our differences. In thinking about our differences again, we need to now apply what? We need to apply the thinking that we do. The thinking there is we have got an asset. We have got an asset. The carry amount is greater than the what? The tax base. What is happening here? I think here. Okay, 135. 100,000, 5 years. No, SARS allows of write-off period of how many years? I think I got it wrong. SARS is 5 years. So
5 years.
5 years, yeah. So this is 5 years. There. 5. 5. That's been so 200 there. This becomes 200. Right. Get amount of an asset greater than the tax base. We have got a deferred tax liability. Sorry, get amount of an asset greater than the tax base. We have got a taxable temporal difference, which should be outside the bracket like that. A taxable temporal difference, good people, will give rise to a deferred tax liability. Yes, we see the negative there. Okay, right. So let's continue now fishing for more things that sit in the statement of financial position, whose carrying amount of the tax base are not the same. I come across from here, even no problem. I come across revenue. There was a revenue received in advance. They received revenue of 30,000, 60,000, but they only delivered the goods in the following year. So that now amounts to revenue received in advance. Revenue received in advance will have a carrying amount here. Right. In terms of IFRS 15, which we're going to do together, revenue received in advance is now called contract liability. Contract liability, because you have received someone's money, but you have not delivered your services. It's now called contract liability. If you use revenue received in advance, you might have problems. Right, it's 60,000. But here's the story about SARS. SARS will have a carrying amount of 0 because they will tax you that amount once. So now we've got a situation of it's a liability. Carrying amount of is greater than the tax base. You will have a deductible temporal difference. It is a deductible temporal difference. A deductible temporal difference, good people, it gives rise to a deferred tax asset. So please, you need to actually practice this. Sharp. Right, continue. As we continue again, we come across. So from there, revenue received in advance. I don't see another thing. It takes us to the allowance for credit losses for current year. 31,000, but 2,000 allow 25%. So I come here and say allowance for credit losses. Accountant is saying 31,000. SARS say we allow 25% of what you allow. So allowance for credit loss, good people, it is a liability because it's something that reduces our asset. So we've got a situation where the carrying amount of an asset of a liability is greater than the tax base. You will have a deductible temporal difference. You will have a deductible temporal difference. And a deductible temporal difference will give rise to a deferred tax asset. Will give rise to a deferred tax asset. Sharp. I don't see any other things there. Those are the only funny stuff that we had that will trigger deferred tax. Those are the only funny stuff that will trigger deferred tax. And yeah, those are the only funny. Right. So you underline the last two always, always. Always the last two. Okay. Right. I want to do something here with you guys before we even go. So this is fine for those 10 marks. But here's the story. To get movement in temporal difference, I want to calculate my movement. I want to calculate my movement. I want to calculate my movement temporal difference for you guys. Oh, which one is which? Right. I might meet myself on mistake. Right. I want to calculate the movement in temporal difference for you guys. You all know maths. So the movement is simple. The temporal difference balance for current year, it's minus 43250 minus the temporal difference balance for last year. It's minus. So minus for separating and minus for the sign that is carried by what? The temporal difference for last year. So now my movement for temporal difference is this minus, I put a minus there, this. This is my movement in temporal difference. So you will see this in our deferred tax calculation. But the sign will change because you're saying it's a deductible temporal difference in the future. You only get refunded this in the future. So in the current year, you will pay tax on it. So when we go to our framework there, we are going to put this as a positive because remember I spoke about the what? The sign change. And that one, I will be explaining it until you guys get to know about it. It's not easy for everyone. Okay, so just be patient with me. Just give me 5 minutes, we'll be done with this. We'll knock off at around 5 past. Now, the last required is for us to what? To do UE. UE, we have to calculate the current tax due. Right, current tax due. So for our current tax due, good people, we are going to say profit before tax. We calculated this one in what? In C. We take the correct one, and then we say what? exempt differences. Okay, and then somewhere there we say movement in temporary differences. Right, this one we said there will be a sign change. Let me take this one. We'll take that one and just change the sign. That's the rule. We are saying it's a deductible temporal difference in the future. In the current year, we get tax on it. And our profit before tax for the purposes of OC, it's this one. We calculated it here. Okay. So we then go and scan forward our exempt differences. We know that. Things like foreign income to 40. Foreign income, it's income that is not taxable. It was included above, remove it. It's not taxable. We have donations as part of the expense, as you can see them there. Donations, it's an expense there, though. They were deducted, but for tax purposes, we can't deduct donations. Please at the back. Okay, so they just brought those few things. They just brought those few things only. Yeah. So exempt differences are done. Box them. For you, because you'll be using a calculator, not Excel, you're adding there, could be for should they. Good. Sign change. Sign differences. Thereafter, we put our profit after exempt differences. That one like that. Right, then I can bring up my movements in temporal differences there. Then I have this. Remember, I said that this one you don't have the right you don't write any name. So there's something that I did wrong. This one.
Yes.
Yes, so this one, right? I have to right. Okay, like this. There's no name for that. If they find two students have been given a name there, they will investigate you further. With which textbook or which accounting standard you're using, that gives you the same answer. All right, so let's assess those brought forward. I didn't hear about anything.
Sorry, sir.
Hello? Yes.
Your profit after exempt differences, it doesn't just subtract that 130,000.
Oh.
The formula there.
Okay. What's happening here? Oh, it should be here now. Here is the story now. What is it? What is this? No, what is it? So now came to me. Right. So it's this minus this. I'm using Excel. They don't say I saw you adding. Right. So this is the profit after exempt differences. And then we have this. Please, this one, know how it looks like that side. It's a very, very serious principle. The sign change. Right. There's no name for this one. And then we say what? This assessed loss brought forward. We don't have N. Then we've got our taxable profits. Yeah. Our taxable profits. Thereafter, we have our current tax at 28%. Some questions can ask you to end on current tax. This is where we are going to end. But when they want the current tax, Joe, it means that there's been some advance payment that is made for provisional tax. So go and separate the provisional tax payments.
So, sorry, sir. Just
Yes.
the 28%, are we going to be given, because now understand the tax is 27% now for the companies?
Yes, they'll give us. Yes, they'll give us. Always in the question, they'll give us. Always.
Thank you.
Always. Yes. All right, so provisional tax payment, I saw this one, 65 plus 55. 65,000. 65,000 plus 55,000. This one we subtract. Okay, so we then have our current tax due. This one is due. We have to pay it over to SARS. Yes, to go to SARS. All right. So we end it here. Next class, we will look at the recon, and then you'll be good to go, because those are the learning outcomes. We'll look at the recon, and then we'll be able to do that one, a disclosure. We'll look at that disclosure and the reconciliation. Yeah, so I forgot what you should be able to prepare what here. It disclosure, and then the tax rate reconciliation. It's another learning outcome. Right, so today we did the first three. When we meet again, we do the last three, and then you guys will be good to go. All right, I'll share these notes. They will help you if you come here, and they'll also help you if you decide not to want to join us and join us next year when you pay. I'm joking. All right. So there we go. I can take questions, good people. In the meantime, don't want to waste your time. Still maybe in the holiday mood. Meaning to say, if there are no questions, I have to share this and end the class. So there are no questions, good people. Let the class end here. The video will be shared. The forms for those who want to join will also be shared, right?
Hello.
Yes.
Yes, I wanted to know what's the difference between FAC 3764 and 3701.
Okay. On 3701, there are topics that there are selected accounting standards that we do for the purpose of 3701. This what we did here, or applies to 3701 and 3764. Isn't it? It's about the topics that are covered. The 3701, it's a year module, so they cover a fraction of 3764. The other topics for 3764, you do them in that other semester or in other modules. 3701 is the old curriculum, old in terms of the degree module, but not in terms of the content, isn't it? So at the end of the day, the two students will have covered all the information, similar information, whether you did 3701 or 3702. But if you're doing 3701 or 3764, if you're doing 3701, for you to have covered the entire syllabus for 3764, you should have done 3701, 3702, 3703, 3704. So 3764 is a combination of 4 previous accounting modules put into one. I don't know if I answered you there.
Okay, I do understand, because I got 3701 and 2. I was left with 3 and 4. So that means I must start afresh.
No, I don't know. You were able to register it.
Yeah, I've registered for 3764.
64.
Yes.
But did you pass the 701, 2, 3, and 4?
No, only 3701 and 2.
Oh, yeah, that one it means. Yeah, I think you can get an advice for them. But if you register for 3764, it means that you also have to go through this because it's one syllabus, one topic, including for the one you have passed in the past. It's unfortunately it's just an education for you.
Okay, thanks.
Okay. All right. If there are no questions, people, we end it here. We'll share this video for you to refer to be going through it before we really start full force. Okay. So let's end here quickly. So thank you for coming.
Thank you
Thank
very
you.
much, sir.
All right, sharp, sharp.
Thank you. Bye.